Welcome to this video debrief of the TX Mock Section B. My name is Aileen Edgar. We'll start this video by looking at questions 16 to 20 from Section B of the mock. So you should already have given Section B a go and now be reviewing the questions along with me. Section B, questions 16 to 20 were around an individual called Marvin who runs a sole trade business and is registered for VAT. We're given information about our VAT exclusive total turnover for the year ended March 24 and also the amounts of input VAT and output VAT on her inputs and outputs, her purchases and her supplies for the most recent 2 years. The information provided there in the table with input VAT and output VAT are going to be useful for questions 17 and 18. And there's also a little bit of information in the first paragraph there around the flat rate scheme that will be useful for question 18. Question 16 is around the annual accounting scheme, of which there's a little bit of information there for you. And the last paragraph of information that was provided in the mock was around VAT returns and invoices, and that's helpful for question 19 and question 20. So we start off with a reasonably straightforward narrative question asking us which of the following statements is an advantage of being in the annual accounting scheme. Note the use of the word advantage. You need to be really clear what it is you're looking for, so be very careful when you're reading. We've got 4 options there. We're going to choose one of these as an advantage of the annual accounting scheme. Are there any that you can quickly eliminate? Can you cut down the number that you're having to choose from if you're unsure in an exam situation? So let's have a think about the annual accounting scheme then. What options have we got here to consider? Once in the scheme, there's never a requirement to leave the scheme. Well, that's not true. There is a limit beyond which a taxpayer needs to leave the annual accounting scheme. So that one's not true. There'll be fewer occasions when penalties could be triggered. Does that sound like that's an advantage? Yes. Is it true? Yes, it is true. We'll come back to discuss why that is in a second. Let's look at the other 2 options and why they're not advantages. There's no requirement to submit a VAT return. Well, I'm afraid you still have to submit a VAT return. You do 1 VAT return a year, but you do still need to submit something. And the taxpayer can choose any number of instalment payments they wish. No, they cannot. They normally make 9 instalments, but they could make a request for 3. So that leaves us with the one advantage there being that there will be fewer occasions when penalties could be triggered. And you're only submitting that 1 return a year, therefore less chance of you being hit with any issues around submitting your returns late. So that's the correct answer for question 16, and I hope you found that one fairly straightforward. Sticking with the annual accounting scheme then, but looking at something a little bit more complicated because we're looking at a calculation here. We've got Marvin, if she decided to join the annual accounting scheme for the year end 31 March 23, what would each of her monthly payments on account have been to the nearest pounds? You've got 4 options there. Now, when we are looking at joining the annual accounting scheme, normally what happens then is we have 9 payments on account being made over the year at the end of months 4 through to 12. And each one of those would represent 10% of the VAT liability from the previous year. The balancing payment is made along with the return, which is submitted 2 months after the end of the annual return period. Now this question is saying if she had considered joining in the year ended 31st March 23, what would each of her monthly payments on account have been? Now, I've just said that the annual accounting scheme is normally based on the VAT liability for the previous year, but we don't have any information for the previous year to this one. And it doesn't say for sure in the question whether she's brand new into business or has been trading for many, many years before this. The only information we've got is covering that 2023 through to 2024 period. So we're just going to assume that this is her first year of running the business. She's thinking, say she had actually joined the scheme then, how would we have worked out her monthly payments for the annual accounting scheme? We would have taken the information from the question that we were given around the output VAT for that year and the input VAT. We'd have taken the difference between those in order to get the overall VAT liability for the year. Each individual monthly payment would have been 10% of that amount of 7,700, so £770. So just watch, the question was asking what each of our monthly payments would have been, not what the total amount would have been. So the answer is £770 then. Had you gone for option 1 there, £642, the mistake you would have made there is dividing the annual amount of 7,700 by 12 months to get a monthly amount. If you'd gone for the 856 option, then you had divided it by 9 monthly instalments, because yes, there are 9 payments made during the year, but each one is actually 10% of the previous year's VAT liability, or in this case, if it's the first year of the business, then it's an estimate of what the liability was going to be. If you'd gone for the fourth option there, £962, you had used the figures from 2024 instead of the figures from 2023. Question 18 saw us move on to a different VAT accounting scheme, the flat rate scheme. This one said, if she had registered for the flat rate scheme for the year ended March 24, by how much would her VAT liability for that year have increased? And again, you're given 4 options. So the information we had in the question that's relevant here is for the year end March 24. We've got the output VAT amount and the input VAT amount, and we've also been given some information about the VAT exclusive total turnover for the year, which was 106,200. Now, the flat rate scheme is, the way it works is to apply a certain percentage, which we were given in the question and you will always be given. And you're given this percentage and you apply it to the VAT inclusive total turnover figure for the period. So our problem here is that we're given the VAT exclusive total turnover figure of 106,200. So we need to know, well, what would the VAT be on that? Well, we're actually given that figure. We're told what it is. For the year ended 31st March 2024, the output, so remember your turnover is the income you're getting from your sales. So what output VAT have you charged on your sales? You've charged £18,590. So that is the VAT on your turnover. So if you take your 106,200 and you add on that 18,590 of output VAT, that gives you the VAT inclusive total turnover for the period. You multiply that by the flat rate given in the question, which was 11%, and then you compare that to, well, what would have happened if we weren't registered for the flat rate scheme? All you would do in that case is you would net off the output and input VAT against each other, and we would have had a balance of output VAT due to HMRC of 9618. So the question asked us, by how much would the VAT liability have increased? So we take the difference between those two, and it would have been £4,109 therefore. So a few different things to think about in that question, a little bit complicated, that one. You need to go back to the real core of what is the flat rate scheme, what figure do we apply the percentage to, and of course some of the multiple choice other options given to you were designed to for the certain mistakes that people would have fallen into potentially here. So the correct answer is 4109. If you'd gone for the 6027 figure, then you were probably using the figures from the 31st of March 2023 instead of 24. If you picked 0, then maybe the reason you chose that one is because actually you worked out that there would have been a decrease rather than an increase in the VAT liability. And the other incorrect option there is maybe you just looked at the flat rate scheme liability on its own and forgot that the question was asking you by how much would it have increased. So you need to make sure you go back and read the requirement again before you make your final decision on what your answer is, just in case while you've been doing calculations you've actually forgotten the specific question that's been asked. In question 19, we're now looking at late VAT returns and payments, and we're being asked which of 4 statements is true. Now, the relevant bits of information from the scenario are shown here. We've got the fact that Morven was late submitting VAT returns and VAT payments for quarters ending June, September and December 23, and our most recent VAT return and payment is also late, being paid and submitted 7 days late. So what we need to think about is what are the rules around late VAT returns. 1 penalty point every time a quarterly return is late. Once you reach 4 penalty points, a penalty of £200 applies at that point. So when you hit that 4th one that is late and you get that point added to you, £200 at that point. Now Morven reaches the 4 penalty points with the late submission that she makes of her March 24 return. But there's also late payment to think about as well. She's late paying that 31st of March 24 return, 7 days late, up to 15 days late. There's actually no penalty charge. So in terms of our answers then, we can rule out quite quickly that penalty of £800 because we're actually only getting a penalty because that 4th return is late. We can rule out the late filing penalty and late payment penalty arising because we've realised that there won't actually be a late payment penalty because she's within the 15-day window. And 2% late payment penalty, well, again, we've said that there won't actually be any late payment penalties. We can rule that one out. So we're left with any further late returns filed will incur £200 penalty unless we get a 12-month period where there isn't a late return. And that one is indeed correct. And the final question in this set in section B is asking us to pick which 2 statements are true about Morven's issuing of VAT invoices. Now we're told in the question that Morven issues invoices to some of our customers, but really you could answer this question without much reference to the scenario. This question is testing your knowledge of what we must include on invoices and the differences between a less detailed invoice and a standard VAT invoice. Simplified invoices can be issued where the consideration for the supply is £250 or less. That £250 is VAT inclusive. So we can rule out the second statement there as it says £250 before VAT. So that means it's exclusive of VAT. Now the customer's details do need to be included on a detailed invoice, but not a simplified invoice. So that first statement there is correct. Electronic invoices can only be issued if the customer agrees to that. So that last statement down there is false. That leaves then the statement that VAT invoice doesn't have to be issued to a customer who's not a taxable person as correct. So hopefully you found that one straightforward. It is perhaps a less well studied area of the syllabus, but it's not complicated. So do make sure you go back and look at the rules around invoices if that's something that you struggled with in this particular mock. Now we're going to move on to the next set of questions in section B, questions 21 through to 25. And as you should know from having had a go at this mock already, these 5 questions were around inheritance tax. The information there on the screen is what you were given in the scenario for these 5 questions. And you can see that relevant bits of information are scattered across the scenario there. So we're going to obviously start with question 21 and work our way through. Some of these are more straightforward than others. So the first question is around the net value for the property, which would have been included in the calculation of Adam's chargeable estate. And the relevant bits of information from the scenario were that the property had a value of 286 in the death estate. There was an outstanding interest-only mortgage of £50,000, and he left the property to his girlfriend. So a couple of things to think about there. We've got this outstanding interest-only mortgage, and does the person that he left the property to have any impact on the value that we would put into the chargeable estate? In terms of the interest-only mortgage, yes, we can deduct that from the value of the property. So we're going to take the 286 and we'll deduct £50,000 from that. Because that mortgage is going to have to be paid off by somebody once the estate is being settled up. And if you're thinking about, well, what about the residence nil rate band? Would that apply here? Well, no, it wouldn't, because he's not left the property to a descendant. He's left the property to his girlfriend, and therefore no residence nil rate band applicable there. So that means we're looking at option number 1 there, £236,000 being the value of 286 minus the outstanding mortgage of £50,000. If you went for one of the other options, perhaps you didn't deduct the outstanding mortgage, or perhaps you added it instead of deducting it, or maybe you treated the whole thing as being exempt, perhaps under the transfer to a spouse, but they weren't married, so that doesn't count. Question 22 was asking us to consider a number of items that were listed in Adam's estate and pointing out which one of those could be deducted in the calculation of the death estate for inheritance tax purposes. So we have credit card debt, we have the promise to pay off the daughter's legal fees, we've got shares, or we could choose the option none of the above. So we did have some information about the legal fees. We were told in the scenario that the legal fees were they'd been subject to a verbal agreement to pay that off for his daughter. So Adam had promised to pay the daughter's legal fees off, and they were £700. Credit card debt was £3,750. The shares were £22,000, or we could go for none of the above. So the one that we can deduct there is the credit card debt. It's not okay to deduct something where we've got a verbal agreement to settle somebody's debt for them, and the shares still need to be taxed. So there's nothing special about those that we can deduct from the calculation. So hopefully you found that fairly straightforward. There will be a mix of narrative and computational questions in your exam. There will be some multiple choice questions that take you a lot less time to get through, and others you might need to spend a little bit more time on. But hopefully you found this one pretty straightforward. Question 23 then was another narrative one, but there was more work to do here because you had 4 statements to look at and decide whether they are true or not, and then you had to look at the options available to you and figure out which pair of the 4 are correct. So we had none of his death estate is going to be taxable because it falls under the spousal exemption rule. So is that true or false? Well, it is false because they were not married. They were not civil partners. They were not married. They were just boyfriend and girlfriend. Even if they lived together, doesn't matter. It doesn't count for tax purposes, and therefore it does not fall under the spousal exemption rules. That means we can rule out the option for statements 1 and 2 and statements 1 and 3. So if you're running short of time in the exam, that'd be a really quick way to increase your odds of picking the right question, right answer. Next statements is the property will be partially covered by the residence nil rate band. No, it won't, because it wasn't left to a direct descendant, it was left to the girlfriend. So statement 2 is not correct either. So even without reading statements 3 and 4, you're left with that being the correct answer. But let's just double check them just to make sure. The death estate will not attract taper relief to reduce the inheritance tax liability. So that statement is indeed correct. And the inheritance tax liability on the death estate will be taxable at 40%. Yes, death tax rate. There's nothing there about charitable givings. So it'll be 40% is the tax rate that we apply there. Taper relief doesn't apply to items in the death estate. So statements 3 and 4 are true. Hope you got that one correct. So question 24 is asking us about how much the inheritance tax liability on his estate is going to reduce had he died in January 2031 instead of January 2024. So that is a 7-year difference, and hopefully you spotted that it was 7 years, and you're thinking 7 years is a magic number for inheritance tax purposes. So what does surviving another 7 years make? What difference does that make to his death estate, to his liabilities? So the key bits of information from the question that are relevant to this particular part is that he made 2 gifts during his lifetime, one in 2015 to his daughter and another in 2023 to his brother. Now that one in 2023 to his brother would have been within the 7 years leading up to his death had he died in 2024. But we're being asked to consider that he doesn't die until 2031. So in that case, the gift to the brother is no longer going to be a failed potentially exempt transfer because it falls out with the 7-year window leading up to his death if he dies in 2031. So how much tax is that going to save then? 40%, so the death tax rate of the transfer, £46,000. So £18,400 less inheritance tax is going to be due as a result of Adam's death if he dies in 2031. So the answer therefore is 18,400, which hopefully you got. If you didn't, then it's possible that you used the lifetime tax rate of 20% instead of the death tax rate of 40% when working out the tax saving. Or you perhaps just thought there was no tax saving achieved by this at all. So if so, go back and look at the dates, revise the 7-year rolling basis for chargeable transfers before death. Have a look at that again. But hopefully you found that one straightforward enough, or at least now that we've gone over it, you could have a go at that one again and get the correct answer. And then we have a really nice question to finish off this particular section on inheritance tax. This one is asking us what date should any inheritance tax due on Adam's death estate be paid? So you've got a choice of 4 dates there. The rule is that it's 6 months after the end of the month of death. When was death? 15th of January 2024. So you go to the end of that month, so the end of January, and then go forward 6 months after that. So that means that the answer is the 31st of July 2024. One of the most common mistakes that I see students making when we're looking at inheritance tax and due dates is that they ignore the bit of the rule where it says after the end of the month of death. They remember the 6 months, but they forget the crucial words after the end of the month of death. So a lot of students would have gone for the 14th of July 2024 then, but it's actually 6 months after the end of the month of death, not 6 calendar months after. Okay, so it's the 31st of July 2024 in this particular case. The last section within section B then, the last case we've got is 5 questions covering capital gains tax. So questions 26 to 30. So we'll look at those now. So there was a lot of narrative information given for these 5 questions. And unlike the other cases, this one actually flowed in the order that the questions were presented. And pay attention to the headings that are used in information given to you in the cases and see if that ties in with the questions. And that way you don't need to worry about reading so much detail in one go every time you're reading each of the 5 questions. So the first question was around the gift of the shares in Big Boots Limited. So some of the information you would need for that, and also question 27 were in that first paragraph of information there. So let's look at those 2 questions now. So in the first of those questions, we've got what date does the claim for the deferral of the gain on the gift of a business asset need to be made? And we've got 4 different options there. And the relevant information in the scenario is that Angel gifted the ordinary shares in an unquoted trading company to her daughter on the 12th of February 2024, and they have both made a joint election to defer the gain as a gift of a business asset. So this means gift holdover relief. Now the rule is that a claim needs to be made within 4 years of the end of the tax year in which the gift was made. So that means if we relate it to this question, the end of the tax year would be the 5th of April 2024. So we're looking at 4 years from that date. So that means that the correct date of the choices there is the 5th of April 2028. And the second question, looking at the Big Boot shares, is asking us to work out what Bernice's CGT liability would be on the disposal of those shares on the 8th of March 2024. So the relevant bits of information from the scenario for this question are that Angel gifted 25,000 £1 ordinary shares to the daughter in February 24. They were worth £10 each at that point. She had originally subscribed for those shares, those 25,000 shares, at face value, so for £1 each. We know that they've made this gift holdover relief election, and on the 8th of March 2024, so not even a month after Bernice got the shares from her mother, she sold them for £250,000 to an unconnected party, so to a third party. So the first thing that's happening in this is that Angel gives the shares to Bernice. And in that case, what we're doing there is saying, well, what is the market value? So even though they've been gifted, we don't put a zero in for the proceeds. We work out what the market value is at that date. So 12th of February 2024, they were worth £10 each. There was 25,000 of them. Proceeds are 250,000. So that's the market value we're using in place of the proceeds. We know that they originally cost Angel £25,000 because we were told that they were subscribed for at face value, par value, so that means at £1 each. 25,000 of them, so they originally cost £25,000. So there's a gain of 225 there. That gain is what is being deferred under the gift holdover relief. How it gets deferred is it will reduce the base cost of the shares from Bernice's perspective. So the value of the shares at the day that Bernice got them from Angel, they were worth £250,000. The gain that is being rolled into that these shares for the future is £225,000. So that £225,000 reduces the value of the shares to Bernice to make the cost of them to her £25,000, a lot less. The impact of that then is when Bernice then sells the shares at some point, she will use £25,000 as her cost rather than the value when she got them of £250,000. So this is how Bernice gets hit with a gain. So when Bernice sells them, she sells them for £250,000 in this case. Yes, when she got them from Angel, they had a market value of 250 at that point, so you'd think, oh, no gain for her. But she has taken on the burden of Angel's gain of 225. How that happens is by using that reduced base cost. So when Bernice sells the shares onto the third party, she now is hit with this gain of 225 and she'll get taxed on that. We were told in the question she's a higher rate taxpayer and she's used the annual exemption already, so we're just taxing that at 20%. So that is a tricky one to think about the different stages. But hopefully, as you've seen there with the sort of 3 different steps that are done, you can see where the numbers flow through and how Bernice is taking on the burden of the gain. Angel isn't taxed on the gain, Bernice is. So that means the answer to this question was £45,000. So question 28 is testing some fundamental understanding of chargeable gains, but also some understanding of chargeable gains reliefs as well. We're being asked to consider the situation where instead of gifting the shares to Bernice, if Angel had sold the shares and then just given the cash to Bernice, which of the following statements would have been true? Now, lots of information there. Might be quicker just to dive into the shorter statements and see if there's any there that you can rule out. Certainly the first one that jumps out to me is the third one there. The cash gift would have been a chargeable disposal. Absolutely not. That's fundamental principles for chargeable gains, that cash is not a chargeable asset, therefore the gift of cash would not be a chargeable disposal. And if we know that, then we can rule out the fourth statement, because if it doesn't qualify as a chargeable asset and disposal, then we wouldn't be able to claim some sort of chargeable gains relief, because there would be no chargeable gain to set any relief off against anyway. So that leaves us with 2 statements. Business asset disposal relief would have been available on the sale of the shares, and the CGT liability would have been paid later than when gifting the shares to Bernice. So the second statement there we can rule out, because under the original situation we were using gift holdover relief to defer the gain to some point in the future when Bernice would pay the tax on it. If Angel instead sells the shares now, she will have to pay tax on it now. So that leaves us with that statement of business asset disposal relief would have been available on the sale of the shares. And yes, it would have, because Angel was a director employed at Big Boots Limited for at least 2 years leading up to the disposal, and she had more than 5% of the shares as well. So that's the correct answer for 28. The next question in the set is on a different part of the scenario, where it's looking at the disposal of that residential property by Bernice. And we've got 4 statements and we're being asked to pick out the one that is correct. We're being asked to consider if she delayed the disposal of the property until May, it would have saved tax. The purchaser would need to pay the CGT due within 10 days of the disposal of the property. Cami could have transferred his unused annual exempt amount to Bernice. Cami's her husband, and the disposal of the property is subject to CGT at 20%. Even without looking at the scenario again, are there any of those statements that you can rule out with your knowledge pretty quickly? There should be. There should be at least 2 that jump out to you straight away without even looking at the information. And actually, if you really know your stuff, you can rule out a third one as well and come to a conclusion as to which one must be the right answer. We can definitely rule out the purchaser needing to pay the CGT due within 10 days of the disposal of the property, because actually it is 60 days, not 10 days. The disposal of the property is subject to CGT at 20%. It's a residential property, so no, it's not. It is subject to tax at 18 or 28%, so you can immediately rule that one out. And what about the annual exempt amount? Cami, the husband, could have transferred his unused annual exempt amount to Bernice. Absolutely not. You cannot transfer annual exempt amount between people. So actually that leaves us with statement number 4. If she delayed the disposal of the property until May 2024, it would have saved tax. Yes, but let's look at why that is the case. So from the information we were given in the scenario, we were told that Bernice had already used up her annual exempt amount for tax year 23-24, but there's no mention of her making any disposals in 24-25. So if she delayed the disposal of the property until May, we're into another tax year and she could use her annual exempt amount from that tax year. The final question of this set then is asking us to consider how much capital gains tax would be saved if Bernice had actually transferred 50% of the ownership of the residential property to her husband Cami prior to its disposal, and we've got 4 answers to consider. So to remember 2 things here that'll help you out is that Bernice is a higher rate taxpayer, so she's going to be paying tax at 28% on the residential property disposal. Cami, however, is a basic rate taxpayer. We're told in the question he's got no taxable income. He's made no chargeable disposals. Therefore, we've got 2 things that can save tax if we transfer 50% of the ownership over to Cami. He could use his annual exemption of £6,000. That's going to save tax at 28% of 6,000, because if we don't do that, Bernice would have been paying 28% tax on that £6,000, but Cami can get £6,000 of the gain at 0. So that would save us £1,680 of tax. And the other place we can save tax is by the fact that Bernice is a higher rate taxpayer, so would be paying 28% tax on a residential property. Cami is a basic rate taxpayer, so would be paying 18% tax. And because he's got no taxable income, we've got 37,700 of gains that he can get taxed on at 18%. So the difference between what she would pay, 28%, and what he would pay, 18%, is 10%. 10% of the amount of gain that could be taxed at the lower rate of 18%, 37,700, his basic rate band that's not been used, gets us our 3,770. Thinking about tax savings at that kind of marginal way, thinking about what does somebody currently pay, what could they pay, what's the difference, how much tax have we saved, is a really, really important skill. So do look out for other questions that do this and practice them. It saves you loads of time in the exam as well, because you don't have to write out full computations. So overall then, we're going to see a tax saving here of 5,450. So that's the correct answer to pick from the options there. If you'd gone for one of the other options, it might be because you used 18% tax rate instead of 28% for Bernice. Perhaps you just thought about saving the annual exempt amount rather than actually saving the tax on the annual exempt amount. And perhaps you missed that difference between Bernice and Cami's marginal tax rate, so the difference between the 28 and the 18%, that 10% tax saving there. So have a look at that one again if you struggled with it. It is one of the trickier ones from the set for sure. I do hope you found this review of the Section B questions from the mock to be helpful, and I wish you the very best of luck with your upcoming exam.